Right, welcome back everyone. Today's a big one, so grab a brew, get comfy because we're doing the proper deep dive on protection insurance. And I know what you're thinking. You're thinking, Patrick, protection? Can we just skip to the bit where we talk about mortgage rates again? But stick with me because this is genuinely the most important conversation I have with clients, and it's one that almost nobody actually wants to have until it's too late. I've done deep dives into the first time buyer journey. We've done the complete remortgage journey. And this is the one that quietly underpins both of them, the complete protection journey. Now, here's the thing. You can get the mortgage right, you can get the rate right, you can get the house, and then life throws you a curveball. And if you've not got the right protection sitting underneath it all, you can lose the bloody lot. So today we're going to walk through it properly. What protection actually is, the four main pillars, how they fit together, what they really cost, what underwriting feels like from your side of the desk, and what happens at claim time. Because the claim is the bit nobody ever shows you. This is going to be a long video. I make no apology for that. You can use the chapter marks in the description to jump around if you want. But if you've got 20 minutes, do me a favor, watch the whole lot. It might be the most useful 20 minutes you spend this year. Right, let's get this kicked off with where most people actually are. Not where they think they are, where they actually are. Imagine you walking across a tightrope. The rope is your income. On one side of the rope is your mortgage, your bills, your kids, your car, the food shop, the dog, the gym membership. You know, that one you keep meaning to cancel. On the other side of the tightrope is everything else you've worked for over the years. Holidays, pensions, savings, that house you actually want to retire to. You're walking across that rope every single month, and every single month you do it, payday comes, bills go out, and the rope holds. Now, what is actually underneath you? For most people in the UK, the honest answer is not very much. Maybe a bit of statutory sick pay if you're employed, maybe a few months of savings if you're disciplined, maybe a death in service payment from work if you've got it. And that's it. That's the safety net. And here's the stat that genuinely shook me when I first read it. The Royal London Deadline to Breadline report, which is a survey of thousands of UK adults, found that 42% of employed adults believe they could only survive a month or less on their savings if their income stopped completely. 42%, that's roughly 13 million people. 1 month and the wheels are off the bus. And the kicker is that even that probably underestimates the scale of the problem, because people optimistically guess upwards when surveys ask about savings. And you know what life looks like. If the boiler dies this week, you can guarantee the car and the dishwasher are going in sympathy. So that's the tightrope. Most of us are walking it without a net. And we've quietly convinced ourselves that we're fine because the rope has always held so far. Protection insurance is literally the net. That is what it is. And that is all it is. It's the thing under the rope. And the entire point of this video is to walk you through what a good net actually looks like. Right, so before we go any further, let's strip the jargon out completely. Protection insurance is a family of products, and it's a really rubbish name for it. And I do wish the industry would get rid of it because nobody outside of the industry understands it. It's basically a set of different insurance policies doing different jobs, all designed to step in when something goes wrong with you. The person earning the money or running the household. Not the house, not the car, you. There are four big pillars to protection insurance, and we're going to take each one in turn and properly unpack it. But here's the headline version so you've got the map before we start the tour. Pillar number 1, life insurance. That pays out a lump sum if you die during the policy term. That money goes to your family, tax-free if it's written in trust, which it should be. We'll come back to that, but this is the one most people have heard of. It's the easy one to grasp. Pillar number 2 is critical illness cover. It pays out a lump sum if you're diagnosed with one of a defined list of serious medical conditions during the policy term, and you survive a short qualifying period, normally 10 to 14 days. So it's cancer, heart attack, stroke, multiple sclerosis, there's dozens of others. The lump sum is yours. You can spend it on absolutely anything: mortgage, adapting the house, treatment, time off, holiday, whatever you want. And pillar number 3, income protection. This is a completely different beast. It pays you a monthly income, not a lump sum, if you cannot work due to illness or injury. It keeps paying month after month, sometimes for years, sometimes right up to retirement age, until you're well enough to go back to work. This is the absolute Swiss Army knife of protection, and I'll explain why in a minute. And pillar number 4 is the family extras: personal accident cover, child accident cover, private medical insurance, hospital cash plans. Some life policies have built-in family income benefits that pay a monthly income to your family if you die, rather than a lump sum. There's a lot of stuff in this category, and the right pieces depend entirely on your situation. So that's the map. The 4 pillars, they overlap and complement each other. A good protection plan typically uses 2 or 3 of them, weighted to your circumstances. Now, here's the bit that nobody wants to admit. You probably need more than one of them. People love to point at one product and go, well, I've got that, so I'm covered. It does not work like that. Life insurance does not pay out if you survive cancer. Critical illness doesn't pay out if you slip a disc and can't sit at a desk for 9 months. Income protection does not pay off your mortgage if you die. They all do different jobs. So when someone says to me, Patrick, I've got life insurance through work, I'm fine, my answer is that's brilliant. Pillar 1, partially done. What about the other 3? So let's start with the easy one. Life insurance is a contract. You pay a monthly premium. If you die during the policy term, the insurer pays out a lump sum, called the sum assured. And that gets paid to whoever you've nominated, usually your spouse or partner, and it's usually written into a trust, which we'll come to in a bit. There are 2 flavours that come up most often. There's level term assurance, where the sum assured stays the same for the whole term. £200,000 on day 1, £200,000 in year 20, useful for interest-only mortgages. Family protection, where you want to leave a meaningful inheritance, or business protection, where the liability doesn't fall as time goes on. And then there's decreasing term assurance. The sum assured reduces over time, roughly in line with a repayment mortgage. Cheaper than level because the insurer's exposure goes down each year. This is the classic mortgage protection policy. You pay it alongside your mortgage. If you die, the payout clears what's left of the loan. Your family gets to stay in the house. Both have got a fixed term, so 15 years, 25 years, whatever lines up with the job the policy is doing. When the term ends, the cover ends. You haven't built up a fund. There is no cash value. If you've never claimed, you've paid for protection you never needed, which is the entire point of insurance. But there's a third flavour of this that's really worth a mention. Whole of life. This pays out whenever you die, full stop. As long as you keep paying the premiums. It's more expensive because the payout is guaranteed eventually. It's useful for estate planning, particularly inheritance tax planning. Most clients don't need it. Some absolutely do. Now let's get on to the really important bit of all this that no one ever talks about, which is writing the policy into trust. By default, a life insurance payout becomes part of your estate, which means it can get caught up in probate, which can take months, and also means it can be assessed for inheritance tax, which means the people you wanted to benefit from it might not get the full amount, and they might not get it very quickly either. Put the policy in trust and none of that happens. The trustees, usually a spouse or a close family member, can claim directly. The money lands in their bank account in days, not months. It sits outside of your estate for inheritance tax purposes, and it bypasses probate entirely. It costs nothing. The insurer provides the trust paperwork free of charge. A good advisor like the one currently filming this video for you will sort it all out as part of the application. And yet, industry data suggests well under half of UK life policies are written in trust, which is a genuine scandal because the trust is free, takes 10 minutes, and could be the difference between a grieving spouse getting the money in 2 weeks or 24 months. This stuff should always be in trust. End of. Right, let's move on to critical illness cover, because this is the one that really catches people out because they hear the name and they think it means any illness that's a bit serious. It doesn't. Critical illness cover is basically a contract that pays a lump sum if you are diagnosed with one of a very specific, defined list of conditions. And that list is set by the insurer. The definitions are very technical, and there's stuff on there I've been trying to pronounce for years. There are minimum severity thresholds. Some cancers are covered. Some early stage cancers are partially covered. Some very early stage cancers are not covered at all. And this is where good advice matters. 2 policies that both say cover for cancer can have wildly different definitions and pay out wildly different amounts for exactly the same diagnosis. Now, before you get scared off, most modern critical illness plans cover a lot. We're talking 50 to over 100 conditions on the better plans. Cancer, heart attack, stroke, major organ transplant, multiple sclerosis, Parkinson's, motor neuron disease, coronary artery bypass, heart valve replacement. The list runs on. And here's the bit nobody mentions until you meet me. Children's critical illness cover, built into most modern plans, often at no extra cost or for a small extra premium. If your child is diagnosed with one of a defined list of childhood conditions, the policy pays out a lump sum, often £25,000 or more, to you. Tax-free, yours to spend on time off, work, adapting the house, private treatment, whatever's needed. Most parents have absolutely no idea that this exists, and the conditions covered are exactly the things that wake parents up at 3 a.m. Now, to look at some of the real-world data that's out there, Aviva published their 2025 claims report. Of all the critical illness claims paid out in 2025, and the breakdown was this: cancer, 54.8%, heart attack, 8.7%. Stroke, 6.7%. Children's benefit claims, 5.8%. That's just one provider. Aviva alone paid out £328 million just in critical illness claims just in 2025. The average payout was just under £70,000. The largest one was 1.4 million. Across the whole industry, the ABI reported that in 2024, UK insurers paid out £1.3 billion in critical illness claims. 1.3 billion. The average claim was £67,600. And here's the stat that should make everybody sit up. Cancer Research UK's most recent figures, published in 2026, show over 403,000 new cancer diagnoses in the UK every year. That's around 1,100 people a day, one person every 80 seconds, and the lifetime risk of being diagnosed with cancer is nearly 1 in 2. 1 in 2 of us. If you're married, look across the table. Now flip the coin. Survival rates have never been better. We are catching cancer earlier, treating it better. More of us are surviving it for 10 years or more than ever did before. It also means more of us will spend a year, maybe 2 in treatment, recovery, returning to life, and that year does not pay for itself. Critical illness cover is the policy that gives you that year back. Right, if you only listen to one part of this whole video, make it this one. Income protection is the most underrated protection product in the UK. It is also, for most working age adults with a mortgage, almost certainly the most important. And here's why. Critical illness pays out if you get one of the conditions on the list. It's brilliant but specific. Income protection pays out if you cannot work, full stop. Whatever the reason. Slip disc, bad knee, burnout, long-term anxiety, concussion that won't shift, surgery recovery, cancer treatment, doesn't matter. If you can't work, the policy pays. And it doesn't pay out a lump sum, it pays a regular monthly income. Roughly half to 2/3 of your normal gross salary, tax-free, every month, like clockwork. This is the closest thing in the protection world to having a second salary sat in the drawer. And the mechanics of how it works is that you choose 3 things when you set it up. Number 1, how much monthly income you want, up to a cap, usually around 60% of your gross. Number 2, the deferred period. How long after you stop work before the policy starts paying? The longer the deferred period, the cheaper the policy. 4 weeks, 13 weeks, 26 weeks, 52 weeks. The right deferred period depends entirely on what sick pay you get from work and how much savings buffer you've got. And number 3, the benefit period. How long the policy will keep paying once it kicks in. There are 2 main flavours, short term, which pays for 1 or 2 years per claim, and full term, which keeps paying for as long as you're unable to work, right up to retirement age. Full term costs more, but full term is, in almost every case, the proper version of this product. Now let's take a look at why this matters so much for you. Let me make this very real. If you're employed, your employer has to pay statutory sick pay. From the 6th of April 2026, the rules changed. You now get statutory sick pay from day 1 of being sick, not after a 3-day wait. The maximum weekly rate is £123.25. That's it. £123.25 per week for up to 28 weeks. And then it just stops. So let's do the maths in our head. £123.25 a week is roughly £530 a month. Your mortgage is probably more than that on its own. Your council tax, your gas, your electric, your water, your phones, your food shop. That's all before you put a tank of petrol in the car. Statutory sick pay is not a safety net. Statutory sick pay is dental floss strung around the Grand Canyon. Now, your employer might pay more than SSP. Many do. 3 months at full pay, 3 months at half pay is fairly common. Some are more generous, some are less generous. The honest truth is, hardly anybody knows what their sick pay policy actually says until the day they need to read it. Take a minute after this video and have a good read. And if you're self-employed, you don't even get statutory sick pay at all. You stop work, the income stops, end of story. So let's put a cap on this with some of the claims data. Royal London 2024, average income protection claimant age 39. Average length of claim 1 year 5 months. The longest claim they continued to pay 13 years and 7 months. And the most common condition actually causing a claim, musculoskeletal, which accounts for 59%. Back pain, joint problems, things that none of us think will happen to us at 39. Aviva's 2025 report tells the same story. They paid £63 million for income protection claims, 4,154 customers supported, and the youngest claimant was 20 years old. The average duration of a claim, 6 years and 4 months. Their longest running income protection claim has been paid for more than 24 years, with over £1.7 million paid to just that one customer. 24 years, £1.7 million. One policy, one person who 24 years ago had the conversation we're having right now and said, yes, I'll have that please, where do I sign? And here's the bit that advisors don't shout about loud enough. Income protection has the highest claims paid percentage of all protection products. Aviva paid 90% of income protection claims in 2025. Royal London paid 86.8% in 2024. These are not products that don't pay out. They pay out properly all the time. Income protection is the policy I push hardest on with almost every client I meet, because if I'm being completely honest with you, statistically, the thing most likely to derail your finances in working life is not dying, it's being unable to work for an extended period, and income protection is the only product designed for exactly that. Right, so let's bring a few of these bits together. Things that don't fit neatly into pillars 1, 2, or 3, but matter enormously for the right family. Personal accident cover. This pays a lump sum or sometimes a monthly income if you have an accident that meets a defined list of injuries: fracture cover, hospital stays, permanent disability. These are usually cheaper than full income protection or critical illness because the trigger is much narrower. They suit people who cannot access full income protection or who want to top up for their active lifestyle injuries that mainstream cover sometimes excludes. Child cover as a standalone where parents have, for whatever reason, not added it to their own critical illness plan. Family income benefit. Now, this is a type of life insurance that pays a monthly income to your family instead of a lump sum if you die. So instead of leaving them £400,000 and hoping they can manage, you leave them, say, £3,000 a month for 20 years. Easier to budget around, often cheaper than the equivalent lump sum policy, particularly useful for families with young children. And then there's private medical insurance. This sits a bit to the side of pure protection, but it's part of the same conversation. The NHS, for all its brilliance, is under pressure. Waiting lists for non-urgent care can be months or longer. Private medical pays for private diagnosis and treatment when you need it, often without a wait. This is particularly relevant if your work depends on you being physically well, or if you have a family condition where speed of diagnosis genuinely matters. And then there's hospital cash plans. These pay a daily benefit for every night you spend in an NHS hospital. Modest amounts, £25, £50 a night, but really useful for covering the small unexpected costs that come with a hospital stay. Parking, taxis, meals for the family, that sort of stuff. And then there's business protection. If you run a limited company, the same principles apply, but the products look slightly different. Relevant life cover, which is life insurance paid through a company as a tax-efficient benefit. Key person cover, which protects the business if a key director or employee dies or becomes critically ill. Shareholder protection, loan cover, a whole separate world, and one I cover with limited company clients as part of the protection conversation. The whole point of this chapter is the 4 pillars are a framework. The right plan for you is rarely just going to be one product. It's 2, 3, or 4 layered and weighted to where you are in life, designed to leave you confident that whatever shows up, the basics are handled. Right, so the question everyone is silently asking but nobody wants to ask out loud: how much does all this stuff cost? And the honest answer is less than you think, considerably less. Now, premiums are personal. They depend on your age, your health, your occupation, whether you smoke, and how long you want it for. There is no honest one-size-fits-all number that I can give you on the internet. But I can give you a ballpark, a real ballpark from real quotes I've put together for real clients in the last few weeks. Now, a healthy 35-year-old non-smoker taking out £250,000 of level term life insurance over a 25-year term, we're talking under £15 a month for £250,000 of cover. Add critical illness cover into the same plan for the same person, and now you're looking at something more like £50 to £70 a month, depending on the insurer and the depth of cover. Still less than most people's phone contract. Income protection for the same person, set up properly with full term cover and a deferred period that matches their employer's sick pay. Maybe £30 to £50 a month depending on occupation. So you can build a properly comprehensive protection plan. Life cover, critical illness, income protection, all 3 pillars in place for somewhere between £60 and £120 a month for most healthy people in their 30s. That's basically a Netflix subscription, a phone contract, and 1 takeaway a month for the peace of mind that whatever happens to you and your family, you're all going to be okay. Now, if you wait, if you put it off, if you decide to think about it till next year, the price will go up. Every year that price is going to go up because age and health are the 2 biggest factors. And one, if not both of them, are moving in the wrong direction every birthday. And worse, if your health changes between now and when you finally do it, A diagnosis, prescription, sometimes even a single GP appointment for the wrong thing can mean exclusions on a future policy or higher premiums, or in some cases, no cover at all. This is the one bit of the conversation where I would gently push, not to upsell, to timestamp. The cheapest, most comprehensive cover you will ever be offered is the cover you can buy today in the health you are in today. Tomorrow, that option may not exist. Right, so assuming we've had the conversation, we've put together a package of cover. The next thing that's going to happen is underwriting. And let's demystify this. People put off applying for protection because they think it's going to be like applying for a mortgage. 8 hours of forms, a 4-foot stack of paperwork, a grandfather clock's worth of waiting time. It's not anymore. Most of it is now a structured online conversation, sometimes a phone interview, sometimes both. Most plans for most people get through underwriting in days, not weeks. So let's just walk through the journey, shall we? Stage 1, we have a conversation. You tell me about your circumstances, your mortgage, your family, your work, your health in broad terms. I tell you what good cover would look like for you, and I run quotes across the whole of the protection market. Then you're going to choose the plan from what we've discussed. We're going to submit the application, and the insurer is going to ask medical questions. Lots of medical questions. They're going to want to know your weight, your height, your blood pressure, your medication, your family history, any operations, any consultations, any sports injuries, mental health, alcohol, the whole lot. The single most important thing I would say about this whole stage is be honest. Be completely and ruthlessly honest. If you're in doubt, declare it, because protection insurance is what's called a contract of utmost good faith. You tell the insurer everything you know, they price the cover. If you don't tell them something and that later turns out to be relevant to a claim, the claim can be challenged or even refused. Non-disclosure is the single biggest reason claims don't get paid. Be honest, and you remove that risk forever. Now, stage 3 is the underwriting. The insurer looks at all of your answers. For most people, most policies, that's the end of it. You get an offer. The cover starts, job done. For some people, the insurer will want more information, a GP's report, a medical examination, maybe blood pressure, maybe blood tests, all arranged and paid for by them. Doesn't mean anything's wrong, it just means the insurer wants the full picture. After all, it's them taking the risk. And then finally, you'll get a decision. Most applications get accepted at standard rates. Some get accepted with a small loading, so that means slightly higher premiums to reflect some kind of risk. And some get accepted with an exclusion, so meaning the policy is in place but won't pay for a specific condition. A small number get declined. And here is where the whole of market piece really matters. Different insurers underwrite different conditions completely differently. One insurer might decline you for something another insurer would happily cover at standard rates. As a whole of market advisor, I can place you with the insurer most likely to give you a clean offer based on your circumstances, and that's a big chunk of what I'm getting paid for. But remember, it's not you actually paying. Unlike a mortgage where I do charge a fee for all the advice and doing the application and getting you that offer, with protection insurance, I don't charge anything. All the advice is free. All the conversations we have is free. I get paid by the insurance provider, not you. But the one thing I will absolutely never look at in a policy is the pay rate. The most important thing is getting you the right cover. Now, there's one thing worth flagging. With many insurers, free cover starts the day you complete the application, not the day the policy formally goes live. So if something happened during the underwriting process, you would already be protected. There's a Royal London case study that demonstrated exactly this. An advisor arranged additional life and critical illness cover for a client. Same day, the client suffered a heart attack and sadly passed away. Just a few days later, free cover meant both the original plan and the additional cover paid out. The family received the full amount, even though they'd never paid a penny in premiums. So there's something I touched on while we were talking about life insurance, and it's worth coming back to on its own because it really matters that much. And that's writing your life insurance in trust. And this is the single best free thing you can do for your family. So what is a trust? In this context, a trust is a legal agreement that says the proceeds of this policy belong to these named trustees on behalf of these named beneficiaries. In practice, if you die, your trustees, who you have nominated in advance, normally a spouse or a sibling or close adult relative, contact the insurer directly. They produce the death certificate, the insurer pays them quickly, usually within weeks. They then distribute that money to the beneficiaries, who are usually the same people you would have wanted to inherit anyway. Now, the big benefit of doing this is that that payment sits outside of your estate. So it's not part of probate. It doesn't have to wait for probate to be granted, which currently in the UK can take 6 to 9 months, sometimes longer. The money lands when your family needs it most, while the mortgage payments are still being demanded, while the bills are still coming in. And if your estate is anywhere near the inheritance tax threshold, the life insurance payout, if it's outside the estate, doesn't push you over. If it's inside the estate, it could mean 40% of it disappears to HMRC before your family even sees a penny. And the cost of doing this? Zero. Zilch. Nada. It's completely free, provided by the insurer, signed during the application, done in 10 minutes. And yet the industry's open secret is the majority of UK life policies still aren't written in trust, which means an enormous amount of money every year sits in probate when it doesn't need to and gets taxed when it doesn't have to be. If you've already got a life insurance policy that isn't in trust, you can absolutely put it into trust now. Contact your insurer or contact me and we can do it on the existing plan. It's a back of an envelope job. There is genuinely no good reason not to. Right, so let's talk about the bit that no one ever shows you. Because when advising on protection, the conversations I find most powerful are the ones where I can show people what actually happens when a policy pays out. Not the brochure version, the real version. Royal London claim statistics are the most useful set of numbers I've got. In 2024, Royal London paid out £751 million in protection claims. 65,385 claims paid. 98.7% of all claims were paid. The youngest customer they paid out for, excluding children's cover, was 19 years old. 19. Aviva, 2025. £1.3 billion paid out across 51,222 claims. 96.9% of all claims were paid. And the ABI's industry-wide figure, the most recent published, is that in 2024, UK insurers collectively paid out £8 billion in protection claims, 275,000 individual claims and many more group claims. That's roughly £22 million per day every single day. These are not products that don't pay. They pay out in vast numbers and in vast amounts every day, all the time. But what does a real claim look like in practice? Let me walk you through a typical journey. And there's one thing I'd like to say up front before we go into this. If you're arranging your protection insurance through myself, then should you ever need to claim, reach out, let me help, because I can. So for a life claim, the family can ring the insurer directly or ring the advisor who placed the cover. Usually the advisor handles the bulk of the admin from there on in. This is what we're here for. The insurer asks for the death certificate. If the policy is in trust, the trustees claim directly. The insurer reviews the application that was made originally, checks it against the medical records to make sure there was no non-disclosures, and if everything matches, they pay. In straightforward cases, this can be done in weeks. It can even be faster. Now, for a critical illness claim, the client will speak to their GP, get confirmation of the diagnosis, and submit a claim form, often with a supporting letter from the consultant. The insurer checks the diagnosis against policy definition and often asks for medical records, and once they've confirmed it all meets the definition, they pay the lump sum. Most major insurers aim to pay critical illness claims within 4 to 6 weeks from point of full medical evidence being received. Now, for an income protection claim, the client submits the claim with a sick note. The insurer's nurse or medical team get involved early, often within days of the deferred period ending. And that's to understand what's wrong, how it's being treated, and what the back-to-work prospects look like. The first monthly payment lands once the deferred period has passed and once the medical evidence supports the claim. Then, crucially, the insurer stays involved. They support rehabilitation. They help with phased return to work where appropriate. Some, like Aviva, they run rehabilitation services in-house to help claimants get back on their feet faster. It's in their interest to do it. And this is the bit I find genuinely moving. Insurers at the best are not the cartoon villain that pop culture sometimes paints. They are large organisations full of nurses, doctors, claims handlers who are paid to help clients get well and get back to life. Most of the time, they do that very well indeed. And every year, every major insurer publishes their claim statistics. They are public documents. You can read them. You can see in plain numbers what percentage of claims got paid and why a small number didn't. The transparency in this is genuinely good. The industry has come a very long way in the last 20 years. So we've talked about the pillars, we've talked about the different types of insurance, we've talked about trusts and claims and various other things, but when in your life should you actually be doing this? And the short answer is now, today, while you're young and healthy, because as we covered earlier, premiums go up with age and exclusions get harder to avoid the longer you wait. The longer answer is protection should be reviewed at every major life event, and the major life events are moving in with a partner, getting married, buying your first home, having a child, moving to a bigger home, changing jobs, becoming self-employed, starting a business, kids leaving home, approaching retirement, and the death of a partner. At every one of these points, the level of cover you have probably needs to change. New mortgage, more cover needed. New baby, new beneficiary, and often more cover. New job, different sick pay scheme, possibly different income protection. Generally, I tell clients to review the protection at least every 2 or 3 years, even if nothing major has changed. Because the market changes, definitions improve, sometimes you can get more cover for less premium, and it's worth a brief check. And the absolute moment to revisit, the one most clients miss, is when you remortgage. Your cover should absolutely keep step with your debt. If you're capital raising, you might need more life cover. If you've cleared the mortgage entirely, you might still want the life cover. But it's worth talking through with someone who knows your situation, because the answer is not always the same. So let's pull it all together with a works example. Made up, but typical of the kind of family I sit down with most weeks. So Mr. and Mrs. Average, he's 37, she's 34, 2 children under 10, £300,000 mortgage with 24 years left to run. Joint household income roughly 70,000. He's employed, she works part-time, also employed, some savings, both healthy, both non-smokers. What would a good plan look like for them? So first of all, let's get pillar number 1 out of the way. Life insurance. Joint decreasing term, sum assured £300,000. 24-year term to match the mortgage, written in trust, pays the mortgage off in full if either of them dies. We could probably also add a smaller chunk of level term family protection on top, maybe £150,000 on him, £50,000 on her, to give the surviving partner a cash buffer beyond the mortgage. Again, also in trust. Then, of course, there's pillar number 2, critical illness cover. Standalone or combined with the life, depending on what makes the most sense for the budget. Sum assured matching the mortgage, so a diagnosis means the family home is paid for. Children's cover included as standard. And then we move on to pillar number 3, the income protection. Full term plans for both of them. Benefits set around 60% of gross income each. Deferred period chosen to match their employer's sick pay arrangements. So this might be 13 weeks. Hers might be 26. We sit down with both employment contracts and we line it up properly. This is where good advice earns its money. And then the final pillar, there's probably nothing further to do in this scenario beyond what's already wrapped into the critical illness with children's cover. We'd flag private medical as something to consider once the budget allowed. We might recommend a small personal accident plan for him if he plays rugby on Sundays. Total cost with everything in place for this family, realistically, somewhere in the region of £120 to £170 a month, depending on definitions and provider. Yes, that is a lot of money. Yes, it is also less than they spend on Sky and the gym combined. And for that money, they can build themselves a proper safety net. But what I wouldn't do them is sell them everything in the catalogue. Layer on cover they don't need. Make the conversation feel like a hard sell. The right plan is the plan that fits the family, not the plan that fits my commission spreadsheet best. The whole point of working with a whole of market advisor is the conversation, not just the policy. So just before we wrap all this up, I just want to talk about one last thing, which is what goes wrong when people try and DIY their protection policies. Firstly, they have life insurance and nothing else. It's easy to buy, it's heavily advertised, the 2-minute online checkout. They genuinely think they're covered, and they are, for the smallest of the 4 pillars. And statistically, the thing that is most likely to affect them, the extended period of being unable to work, has no protection at all. You've just insured yourself for the thing least likely to happen to you. Well done. The next mistake is that people think they have cover through work. They assume it's enough. Death in service is usually a multiple of your salary if you die whilst in employment. It is one of the great free benefits of working for a decent employer. But it dies the day you leave the job, and it covers you for one thing, which is death while you're employed there. This is absolutely not a substitute for personal protection. And thirdly, when people are setting stuff up on their own, they very rarely write it into trust. So even if the policy pays out, the money's getting stuck in probate, it's getting taxed if the estate's large enough, and arrives weeks or months after the family really needed it. The fix takes 10 minutes and costs nothing. There is no reason to leave this undone. And fourth, they did it all right 5 years ago, but nothing's been reviewed since. 2 kids, a remortgage and a changed job later, that cover that once fitted them perfectly is now wildly out of date. Protection is not a buy it and forget it product. It's a living thing that should move on with your life. So if you take only one thing away from this video, go and look at what you have, write it down, the provider, the cover amount, the term, the premium, whether or not it's in trust, whether it's level or decreasing, whether it includes critical illness or income protection or just life. And then ask yourself honestly, does it fit my life as it is today? If yes, brilliant, you're sorted. If you don't know, that's almost certainly a no. And that's okay too. That's what an hour with a good advisor like myself is for. Right, so finally, let's wrap it all up. If anything in this video has nudged you, even a little, even just a flicker, please do something with it. Don't let it sit on the back burner with all those other things you keep meaning to do but never getting round to. The easiest way to get started is to fill in my inquiry form. The link's in the description below for this video, and if you're watching on YouTube, it's also in the comments. Tell me a little bit about your situation, whether you've got cover already, roughly what your circumstances look like, and I'll come back to you and we'll arrange a proper conversation. I work across the whole of the UK, phone, Zoom, in person. If you're in around Hinckley, Lutterworth, Market Harbour, or anywhere in the East Midlands, the conversations we have, all the advice, that's all completely free. If you take out a policy, I get paid by the provider. There is genuinely no pressure. We talk through where you are, what good looks like for you, and you decide what to do with that information. If you'd rather just have a question answered, comment on the video and I'll get back to you. If you'd rather email, the address is in the description also. If you'd rather phone, the numbers are on there too. But please do something. The whole point of this video, all 20 plus minutes of it, was to make protection feel less like a scary blank wall and more like a conversation. The conversation costs nothing. The cover in most cases costs less than you expect. And the difference it makes when the day comes that you need it is the difference between a difficult year and a catastrophic one. Right, that's me done. So as always, I'm Patrick Weightman, your local East Midlands mortgage and protection advisor, serving clients up and down the UK. Drop me a like and a follow for more and hit the links in my bio to get in touch. Think carefully before securing debt against your home. Your property may be repossessed if you do not keep your payments on your mortgage. Speak to you soon. Bye-bye.